when he's in front of a very structured statement, he's fine, I think. I think what happened a little bit yesterday and what happened on October 3rd was when you see him in a more sort of off stage, if you will, condition where he's just in a Q&A mode and seems to be answering a question more off the cuff. It seems like he almost, these sort of hawk, I don't know whether hawks have teeth, but the hawk teeth start really sort of showing. And people, I think, really wonder, wow, is this guy really just going to, hike us into a recession? And he's so determined to normalize policy, whether it's on the balance sheet
or is it just bad communication skills?
Or yeah, but he doesn't necessarily
kind of
have
gruff,
sort of
like whatever, we're going to go here.
Yeah, no, well, I think there's a sort of you can sense there's a rigidity in his thinking, and there's a lack of nuance that some of his predecessors maybe had more of there. Whether it's bad, it's bad communication. I think it's a little bit, it depends on your viewpoint there.
Did the market overreact? 730-point drop, Michael, in under 2 hours.
Look, he gave us a lot of, what's changed in not the market, but in the economic data since September? Not a lot, right? I mean, data's been held up pretty well, and he gave us a fair amount of, he gave us lower dots, he gave us a lower narrative on inflation and all that, right? So there was a lot in there for if you were expecting a dovish response. I think as many people have commented on, it's this sort of the elephant in the room is the balance sheet, right? And is global liquidity going to go really into contraction? And is Powell going to do anything? Would he push pause on the balance sheet? And arguably, I think if he articulated a more softer approach on the balance sheet, but a firmer approach on rates, it actually may be much more constructive for equity prices.
Yeah, and what Michael is talking about, I know, listen, it's early out there, folks, but I think remember, there's two sides to the Fed story right now. It's kind of like an NBA team. You've got two stars that kind of maybe have some nagging injuries. Right. And the team goes on a losing streak, and you can blame it on one star, which would be rates. Right. But you've got this other star, which is the balance sheet, which is also banged up. You actually think that the balance sheet side, right, the second-tier star, is a bigger problem.
Yeah, well, that second-tier star has been in the background, looming in the background. No one ever talks about the balance sheet. Certainly, if the Fed didn't, they just.
No, we do a little bit, but it's wonky. It's kind of weird. It's hard to talk about.
But it's sort of zoom out for a second. The Fed's been doing minus 50 a month. The Bank of Japan is doing a little bit more than positive 50 a month. They kind of offset each other. From a global perspective, the ECB is going to 0 a month. They don't seem to be going into QT mode anytime soon. But if they do,
quantitative tightening.
That balance sheet that has expanded from just a couple of trillion 7 or 8 years ago to north of 15 trillion and was a big part of the global liquidity discussion. It really did help PEs expand on the S&P from 12 up to 19 during that rally and so forth, and credit spreads to come down. If that is going to contraction, I think that's going to be more disruptive to risk assets than whether we get 1, 2, or 3 hikes.
Very quickly, I know you got your 2019 outlook coming out. We don't want to give too much away. We'll get you back on early in the new year to go through it. Give us a tease.
The tease is that the cycle is we are in the 5th or 6th inning of this cycle. It's an unexciting cycle. It's lower nominal GDP acceleration, but extended, and risk assets will perform better in that, assuming that the trade issues come in and are resolved in a constructive way the next few months.